Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the conventional fund business for the weekend of Wednesday, March 20th, 2019. We saw about $21.4 billion exit the conventional fund business this week. It's the second week in a row that we've actually seen outflows. And the news that it's so big, by the way, is primarily just from money market funds. Although, even though we had fairly strong returns, I think we had about a 0.83% average return for all the indices that we follow. That's index returns for the week. So at least it was plus side. I think we only had one negative return out there. And I think it was one of the small cap indices that was actually the negative. But anyways, we really saw some actually pretty good news as far as the Fed goes. They became more dovish after the FOMC meeting. Basically, they came out and said, listen, we're going to be very guarded on our interest rate hikes and also even reducing our balance sheet. It looks like we probably won't even have any more hikes this year, and so I think that was a boon for equity funds, and that's why we saw an uptick in returns. But that really didn't pan out all that well as far as the flows into our macro groups. Let's take a quick look at our macro groups and see how the news actually panned out. We take a look at it, and equity funds saw about $3.1 billion outflow. And this is maybe just to the cause of that we've seen some ups and downs on the China news, on whether the China and U.S. trade agreement is going to go through. We had some mixed news out there during the week, but I think people at the end of the week actually became a little bit more sanguine about the issue with U.S. delegates going over to China, and then in anticipation of Chinese delegates coming back over here in the following week. So that was pretty good. Taxable bond funds actually saw net inflows, about $5.1 billion. Again, this is probably good news from the Fed saying they're going to shut down the interest rate hike, so that was actually a boon for them. Muni bond funds saw about $1.3 billion, and as I said, money market funds saw the biggest outflows, $35.7 billion in outflows this week. Again, tax season, pretty normal for us to see March 15th, those type of outflows to occur. Let's go ahead now and take a closer look at the open-end portion of equity funds and see what happened in that first. Actually, we saw a 0.71% return for the average equity fund. It's the 11th week in 12 that we've actually seen plus-side performance. But for the fifth consecutive week, we've seen outflows, this time to the tune of $3.1 billion. Domestic equity funds, again, this is excluding anybody who invests abroad or globally, basically saw outflows of $3.7 billion. It is the sixth consecutive week they've seen outflows. 0.36% return, though, for the second consecutive week they've seen upside performance. And on the non-domestic side, we saw inflows of about $618 million. First week in 5, they've seen net inflows, and the return was 1.47%. Fourth week in 5, though, that we've seen upside performance from that group. Large cap funds was a pariah, as they have been of late. We've had a couple of times where we've seen some plus side inflows, but really, over the last year and a half, 2 years, we've seen large cap funds really take it on the chin, this time to the tune of about $2.7 billion. But equity, on the equity side for non-domestic, we see global equity funds taking in about $524 million. So that was the story on that side. Let's go ahead and turn our attention now, though, towards the ETF side of the equity business and take a look at that. Second consecutive week, we've seen plus side inflows, $6.7 billion this time. And at the top of the group, we saw the Invesco QQQ Trust 1 actually taking $2.9 billion, the Spider S&P 500, SPY, taking $2.4 billion, and on the bottom side, we saw iShares MSCI EFA ETF lose about $1.1 billion, and the Technology Select Sector Spider Fund lost about $1.1 billion as well. So let's go ahead and turn our attention now to the taxable bond fund side of the universe. We'll first take a look at the conventional fund business. 10th consecutive week, we've seen net inflows, this time to the tune of $5.1 billion, and it is the 11th week in 12 we've seen plus side performance, this time to the tune of about 0.39%. Corporate investment grade debt funds took in the lion's share of the flows this week. $4.2 billion went to that group. Balance funds took in about $1.3 billion. And on the bottom side, we see flexible portfolio funds handing back about $1.6 billion. Let's go ahead and turn our attention now to the ETF side of the taxable bond fund side and take a look at what happened there. Basically, we see that on the ETF side, about $1.5 billion inflow, second consecutive week they've seen net inflows. And the iShares iBox dollar high yield corporate bond fund ETF was the big attractor, $489 million there. iShare core total US dollar bond market ETF took in about $311 million, and iShares 7 to 10 year Treasury ETF was at the bottom at a loss of $740 million. And the runner-up to that loser group was iShares JPM US Dollar Emerging Market ETF, losing about $219 million. Let's go ahead and turn our attention now towards the tax-exempt bond fund side. See what happened in there. Muni bond funds took in about $1.3 billion, 11th consecutive week they've seen net new money coming to that group. It's the 8th consecutive week that they've actually had plus side performance, 0.20% return here. And the big attractor of money was the general insured municipal debt funds group, took in about $523 million, and high yield municipal debt funds took in about $448. And on the ETF side of the universe, we see that they took in about $169 million. That has not become a real big portion of ETF flows yet, but people are still staying interested in that group. Last, let's take a look at our money market funds. Money market funds, as I told you, had a big outflow. This is the second consecutive week they've seen outflow. This week, though, it was at $35.7 billion. And how this broke out, institutional money actually pulled up $41.8 billion, while retail investors, being a little bit risk averse, as we said at the top of the segment, retail investors actually put $6.1 billion into work back into money market funds. Now, again, the reason we see institutional money markets taking, losing money, very common. March 15th is the deadline for a lot of the limited liability corps and stuff like that have to pay taxes, and so we're seeing that type of flow, and it's pretty seasonal. On the tax-exempt money side, though, we did see net inflows, but only to the tune of about $8 million, not billion, 8 million, very small inflows, so that was kind of the story there. Well, that's it for me this week. We are going to keep our eyes, obviously, on what's happening over the next 2 weeks. Between the China and U.S. Government as far as trade concerns go. I think it's going to have, all eyes are going to be on that issue. And then also on what's happening with the Brexit situation. Well, if I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can wait till next week and see what one of our analysts talk about for the flows trends of the week. My name is Tom Roseen. Thank you for joining me. I wish you the best in your wealth planning and creation.